While everyone is arguing over daily price action, the most dangerous signal in the market is flashing red on a chart almost nobody is watching. Most investors are operating under a massive misconception that could destroy their portfolios by the time we reach 2026. They believe that Bitcoin and gold are fighting the same battle, serving as identical safe havens against a collapsing dollar. But let us look under the hood, because the correlation data tells a completely different and much more urgent story. If you are allocating capital today based on the logic of 2020 or 2024, you are walking into a trap. Here's the kicker that the mainstream financial news will not tell you because it does not fit their simple narrative. For the last 6 months, the correlation coefficient between Bitcoin and gold has been drifting towards zero, and at times, it has even turned negative. This is not a glitch in the matrix. It is a fundamental structural shift in how smart money is treating these two assets. The reality is much simpler and harsher than the safe haven fairy tale implies. Gold is currently acting as a hedge against geopolitical instability and central bank distrust. Bitcoin, on the other hand, is acting as a leveraged bet on global liquidity expansion and the debasement of currency, but with a risk profile that resembles a tech stock on steroids. We need to bust this myth right now before we discuss the strategy for 2026. A safe haven is an asset that holds value when the building is on fire and everyone is rushing for the exits. Gold has proven this role over 5,000 years, maintaining purchasing power while empires crumble. Bitcoin has certainly performed exceptionally well over the last decade, but let us be honest about its behavior during liquidity crunches. When the market panicked in previous cycles, Bitcoin did not act like digital gold immediately. It acted like a high beta risk asset. It sold off alongside the Nasdaq and the S&P 500 because leveraged traders were forced to liquidate positions to cover margin calls. However, here's where the data gets interesting and why the next 2 years are critical. We are seeing a divergence in who is buying these assets and, more importantly, why they are buying them. Central banks around the world, particularly in the East, are buying physical gold at a record pace to diversify away from United States Treasury bonds. They're not buying Bitcoin to back their currencies yet. They are buying gold because it is a neutral reserve asset with no counterparty risk. Conversely, the flows into Bitcoin are being driven by institutional capital managers, hedge funds, and the exchange-traded funds. These entities are not buying insurance against the end of the world. They are buying exposure to the fastest horse in the race against monetary inflation. This distinction is absolutely vital for your portfolio construction. If you treat Bitcoin purely as a safety net, you will likely be shaken out by the volatility that is coming. We are entering a period where the global debt burden is becoming mathematically unsustainable. The United States interest expense on its debt has skyrocketed, now costing more than the entire defense budget. There are only 2 ways out of this debt trap: default, which is unlikely, or inflate the debt away by printing more money. This is the thesis for both assets, but they react to the stimulus in different timeframes. Gold is the slow, steady grinder that realizes the currency is losing value. Bitcoin is the sensitive liquidity gauge that fronts-runs the printing press before the ink is even dry. If this level of deep dive analysis is helping you see through the fog of war, consider joining our community with a subscribe to stay ahead of the crowd. Now, let us look at the historical parallels to understand where we are heading. In the 1970s, gold went parabolic because inflation was running hot and real yields were negative. Today, we are seeing a similar setup, but we have a digital competitor that absorbs a significant portion of that speculative premium. In 2021, we saw Bitcoin explode upward as the money supply expanded by 40%. But when the Federal Reserve tightened rates in 2022, Bitcoin corrected nearly 80%, while gold held up relatively well. That was the proof that Bitcoin was not yet a mature safe haven. It was a liquidity sponge. As we look toward 2026, we must anticipate a scenario where the Federal Reserve is forced to cut rates aggressively to save the bond market. This is the moment where the correlation might temporarily realign, but for very different reasons. Gold will rise because real yields will collapse. Bitcoin will rise because the market will flood with cheap dollars looking for a home. Most retail traders make the mistake of going all in on one or the other, treating it like a sports team rivalry. The smart money playbook is about understanding the beta, or the volatility relative to the market. If you want to preserve wealth that you have already made, gold is the defensive lineman. If you want to generate life-changing wealth and can stomach 30% drawdowns, Bitcoin is the offensive striker. The danger lies in thinking Bitcoin is defensive. It is an offensive weapon against currency debasement. Let us discuss the specific on-chain data that supports this thesis. We are seeing long-term holders of Bitcoin continuing to accumulate, locking supply away in cold storage. The amount of Bitcoin available on exchanges is hovering near multi-year lows. This creates a supply shock dynamic that gold simply does not have. Gold has an elastic supply. If the price goes up, miners dig more, and people melt down jewelry, bringing more supply to the market. Bitcoin has a perfectly inelastic supply schedule. No matter how high the price goes, the protocol will not release more coins. This is the primary reason why Bitcoin outperforms gold during periods of extreme liquidity expansion. However, this also means that when liquidity dries up, the price of Bitcoin must fall faster to find equilibrium. So, what is the strategy leading into 2026? Do not fall for the narrative that you must choose one side. The winning portfolio for the coming cycle likely includes both, but weighted according to your risk tolerance. We are seeing a structural breakout in the correlation between global liquidity M2 money supply and Bitcoin price. Every time the global money supply ticks up, Bitcoin responds with a lag of about 2 to 3 weeks. Gold responds much slower, acting as a dampener on portfolio volatility. If you are heavy in crypto, having a gold allocation actually allows you to hold your Bitcoin longer. It gives you a psychological anchor and a liquid asset you can sell if you need cash, so you are not forced to sell your Bitcoin at the bottom of a correction. The myth of the safe haven is dangerous because it breeds complacency. Investors think they can buy Bitcoin and sleep soundly like they own a government bond. The reality is that you are buying a call option on the future of the monetary system. By 2026, we expect the lines between these two assets to blur further as Bitcoin adoption matures. But until then, treat volatility as the price of admission for the superior returns Bitcoin offers. Do not be surprised if we see a significant flush in the markets where Bitcoin drops while gold rallies. That is not a failure of the asset. That is the market deleveraging. That is the moment the sophisticated investor steps in to deploy capital, while the retail investor panic sells. You need to watch the real interest rates, that is, the interest rate minus inflation. When real rates are high, these assets struggle. When real rates turn negative, which is the mathematical inevitability to service the sovereign debt, both assets will fly. But Bitcoin will likely fly 3 to 5 times higher and fall 3 to 5 times harder along the way. We are playing a game of probability, not certainty. The institutionalization of Bitcoin through exchange-traded funds has introduced a new dynamic. It means Bitcoin is now tied to the quarterly rebalancing flows of massive pension funds and wealth managers. This could actually dampen the volatility over time, but we are not there yet. Right now, the leverage in the crypto system is still high, meaning we are prone to cascades. The narrative for 2026 is not Bitcoin versus gold. The narrative is hard assets versus fiat currency. They are allies in the same war, fighting on different fronts. One guards the castle, the other conquers new territory. If you ignore this nuance, you risk being on the wrong side of the trade when the liquidity tide turns. Focus on the liquidity flows, ignore the day-to-day noise, and size your positions so you can survive the volatility. The biggest risk is not being in the market. The biggest risk is being shaken out of a winning position because you misunderstood the asset class. If you found value in this deep dive into market structure, a like helps the algorithm share this data with more serious investors. Nothing mentioned here is financial advice. All investment strategies and investments involve risk of loss. You should consult with a professional financial advisor before making any investment decisions.